The first issue is improper revenue recognition. In this case, NTK delivered good to Omega Trading Berhad, but payment will only be received after Omega sells the good to end customer. Despite this, Ahmad instructed the accountant to recognize the revenue immediately. Under FAR513, revenue should only be recognized when control has transferred and the customer has an unconditional obligation to pay. Therefore, recognizing revenue immediately is inappropriate. The correct accounting treatment is to keep the goods as inventory until Omega successfully sells them to the end customer. Revenue and trade receivables should only be recognized once payment becomes unconditional. This ensures the financial statement reflect the true economic substance of the transaction. Management must make several assumptions and estimates before recognizing revenue. They need to assess whether Omega had obtained control of the goods, whether payment is likely to be collected, and whether this arrangement is a complete sale or a consignment arrangement. Therefore, professional judgment is essential to ensure the revenue is recognized at the correct time. This issue is also an example of earning management. Ahmad recognized revenue early to increase the reported profit, improve earning per share, meet the loan covenant, and also increase the employee compensation. As a result, the financial statement become misleading and may reduce investor confidence in the company. As you guys can see, recognizing revenue too early causes revenue, net profit, trade receivable, and also retained earnings to be overstated, while the inventory is understated. Therefore, the financial statement no longer provides a faithful representation of NTK's financial position. The second issue is the manipulation of the useful life of property, plant, and equipment. Ahmad revised the useful life without any engineering assessment and instructed Alia to adjust the records. Under MFRS 116 and MFRS 108, changes in useful life must be supported by reliable evidence and treated as a change in accounting estimate. The correct treatment is to continue using the existing useful life unless there is a sufficient technical evidence to support a revision. Any approved change should be applied prospectively so that depreciation reflects the actual condition of the asset. Determining the useful life of an asset requires management to make assumptions about the future usage, maintenance, and the asset condition. They must also estimate the remaining useful life and possible wear and tear. Before making any changes, management should obtain technical evidence and exercise sound professional judgment. This issue also reflects the earning management. By extending the useful life of the asset, depreciation expenses decrease and reported profit increase. Ahmad's intention was to improve the company financial performance rather than reflect the true condition of the asset. As you can see, depreciation expense is understated, while the net profit, property, plant and equipment, and also retained earnings are overstated. This creates a misleading impression that NTK is more profitable and financially stronger than it actually is.
The third financial reporting issue identified in this case is the failure to disclose dilute earning per share or the EPS. In this case, NTK Corporation issued convertible debt to finance its new investment project. Convertible debt is a financial instrument that can be converted into ordinary shares in the future. However, the director believed that the convertible debt would not affect the company's earning per share. Therefore, he instructed the accountant to disclose only the basic EPS with minimal additional information and omit the dilute EPS disclosure. This is a financial reporting issue because investors are not provided with complete information regarding the possible dilution of earnings if the convertible debt is converted into ordinary shares. As a result, the financial statement may present a more favorable financial performance that they actually do. The relevant accounting standard is MFRS 133, earning per share. According to MFRS 133, company must disclose both basic EPS and dilute EPS whenever they have potential ordinary shares, such as convertible debt, share option, or warrants. The purpose of dilute EPS is to inform investors about how future conversion of this financial instrument could reduce earnings available to each ordinary shareholder. Therefore, the appropriate accounting treatment is for NTK to calculate both basic EPS and dilute EPS and disclose both figures in the financial statement. If the convertible debt has a dilutive effect, the company must present dilute EPS together with basic EPS to comply with MFRS 133. Wherein dilute EPS, management must apply assumption, estimates, and professional judgment. First, the company assumed that the convertible debt is converted into ordinary shares at the beginning of the reporting period, or on the date it was issued if later. Second, management estimate the weighted average number of ordinary shares after conversion and calculate the effect of the conversion on earning per share. Finally, professional judgment is required to determine whether the convertible debt is dilutive. If the conversion reduces EPS, then dilute EPS must be disclosed. In this case, Ahmad failed to exercise appropriate professional judgment because he omit the required disclosure without properly assessing the effect of the convertible debt under MFRS 133. The issue is related to earning management through selective financial reporting. Although the figures were not directly manipulated, management failed to disclose dilute EPS as required by MFRS 133. This reflects several earning management concepts. First, capital market expectation, where the management aimed to present a stronger EPS to maintain investor confidence. Second, agency theory, as a management prioritize its own interest over transparent reporting. Third, for information asymmetry, because management will have important information from investors. As a result, the company appear financially stronger, which could influence investor decisions. The failure to disclose dilute EPS affect the presentation and disclosure of a financial statement. Although basic EPS remain unchanged, omitting dilute EPS result in incomplete reporting and non-compliance with MFRS 133. As a result, investor cannot assess the impact of potential share conversion, reducing transparency, and possibly leading to poor investment decision. Moving on to issue 4, which is the failure to recognize doubtful debts arising from an adjusting event under MFRS 9 and MFRS 110. In this case, a DK major customer, FAR513 Berhad, was declared bankrupt before the financial statements were authorized for issue. This bankruptcy significantly affect the collectability of NTK trade receivable. However, Ahmad Ishaq earlier not to recognize the impairment loss because he wanted to maintain higher profits, comply with the loan covenant, and support the company's expansion plans. As a result, the doubtful debt was omitted from the financial statement, causing NTK to overstate its assets and profits. This issue involves two accounting standards, namely MFRS 110 and MFRS 9. According to MFRS 110, the bankruptcy of customer before the financial statement are authorized is considered an adjusting event because it provides evidence that the receivable was already impaired at the reporting date. Therefore, NTK must adjust its financial statement. In addition, MFRS 9 requires companies to apply the expected credit loss or ECL model. Since Alphatech is no longer able to pay its outstanding balance, NTK should recognize an impairment loss by recording an allowance for expected credit loss. The correct journal entry is to debit impairment loss and credit allowance for expected credit loss. This ensures that the trade receivable are reported at their recoverable amount and that the financial statement comply with relevant accounting standards. Management must make several assumptions, estimates, and professional judgment. The main assumption is that Alpha Dash bankruptcy indicates that if the receivable is no longer fully recoverable. Management must then estimate the amount of the expected credit loss by assessing the probability of default and the amount expected to be recovered. Professional judgment is also required to determine whether the bankruptcy is an existing event. Since the bankruptcy occurred before the financial statement were authorized, management should recognize the impairment instead of simply disclosing the event. Therefore, Ahmad's decision to ignore the impairment were inconsistent with the requirement of MFRS 9 and MFRS 110. This issue is an example of accurate earning management because Ahmad deliberately failed to recognize the expected credit loss, which overstated profit and asset. His decision was motivated by the need to avoid breaching the loan covenant and maintain investor confidence. This reflects the debt covenant hypothesis, agency theory, and information asymmetry, where the management prioritizes its own interests and withheld important financial information from stakeholders. Failing to recognize doubtful debt affect both the statement of financial position and statement of profit or loss. Trade receivable, total asset, and equity are overstated, which impairment expenses are understated. As a result, net profit and earning per share appears higher than they should be. Although recognizing the impairment may increase the debt to equity ratio and affect the loan covenant, it ensured compliance with MFRS 9 and MFRS 110 and provides a true and fair view of NTK financial position. Overall, this is an example of accurate earnings management, where management intentionally overstated financial performance by not recognizing the expected credit loss.
There are four ethical issues arising from the financial reporting decision made by the director, Ahmad. The first issue is Ahmad instructed the accountant to recognize the full revenue from the transaction immediately on the basis that the goods had been delivered. Secondly, Ahmad decided to revise the useful life of the several high-value assets at NTK's manufacturing facility. Thirdly, NTK Corporation issued convertible debt to fund the new project as Ahmad was confident this would not adversely affect EPS. And lastly, Ahmad instructed Alia to exclude the information about bankruptcy of major client, which is FAR513, from the financial statements on the grounds that it was not relevant to the current reporting period. Now I will relate the ethical issues with the author 3. Firstly is observe and think. Instead of using observation and thinking to identify what is right and what is wrong, Ahmad chose to ignore accounting regulations because of management pressure. Secondly is understand. Ahmad understands the accounting rules but manipulates them and manufactures false narrative. His moral judgment is absent. Thirdly, remember and reflect. Rather than reflecting on past experiences to build continuous ethical practice, Ahmad shows unethical behavior throughout the financial period. And lastly, remorse. Ahmad does not quickly repent or correct the corporate financial position when a major client goes bankrupt. Instead, he instructed Alia to exclude this information from the financial statements. Now, I will relate Niyam with the ethical issue. Niyam is stand for Niyat, Ikhtiar, Amanah, Muraqabah and Natijah. So the first N is Niyat. Ahmad's intention, which is Niyat, are unethical because they are driven by self-interest and corporate greed. He wants to achieve his main goals by making the company's financial performance appear stronger than it actually is. Next is I. I is stand for Ikhtiar. Ahmad's efforts, which is his ikhtiar, are directed towards manipulating the company's financial statements instead of following honest business practices. He does this by recognizing revenue prematurely, changing useful life of assets, hiding comfortable debts, impact, and withholding information about Alpha Tax bankruptcy. Next is A. A is stand for Amanah. Ahmad breached his duty and the trust placed in him as a director of a public listed company. Internal and external users are rely on him to present a true and fair view of the company's financial position, but he violates this trust by manipulating the financial records. The next M is Muraqabah. Ahmad shows a total absence of Muraqabah by failing to consider whether his actions are ethical or lawful. And the last N is for Natijah. The immediate result is a set of fraudulent financial statements that misrepresent the company's true financial position. Although this may temporarily prevent a breach of the loan covenant, but it could lead to serious damage of company's reputation. Now, I will discuss about the ethical dilemma faced by the accountant, Alia. As Alia was still on probation, she was concerned about the potential repercussions of challenging her director's instructions and therefore complied with directives despite having concerns about the appropriateness of the financial reporting decision. Now I will relate the dilemma faced by Alia with author 3. First is observe and think. Alia successfully observing Ahmad's directive regarding revenue, assets and bankruptcy concealment. She immediately thinks these actions are unethical. Her conscience is activated and she becomes concerned about the appropriateness of these financial reporting decisions. Next is understand. Alia understands why the instructions from Ahmad are wrong. She knows that manipulating the financial statement would mislead stakeholders and result in false financial reporting. However, her moral judgment is affected by the fact that she is still on probation and fears the consequences of going against Ahmad's instruction. Next is remember and reflect. At this stage, Alia fails to maintain ethical behavior because she is intimidated. Although she knows the correct course of action, the fear of losing the job while probation leads her to follow Ahmad's instruction instead. As a result, she is unable to uphold ethical practice under pressure. Lastly is remorse. Since Alia followed Ahmad's instruction, she should feel remorse for compromising her professional integrity, learn from the experience and take steps to prevent similar situations in the future. Next, I will discuss about Niam that can be related with the dilemma faced by Alia. Firstly is niat. Alia's initial intention, niat, is ethical. She wants to act as a professional accountant and comply with accounting standards. However, her attention is influenced by her desire to secure the job. Next is ikhtiar. Alia faces a difficult dilemma in deciding how to act. She must choose either following accounting standards by refusing Ahmad's instruction or protecting her job by obeying them. In the end, fear and pressure led her to follow Ahmad's instruction. Next is amanah. As a professional accountant, Alia has a responsibility to act honestly and objectively. However, she fails to uphold this trust and become involved in the financial misrepresentations by following Ahmad's instruction. Next is muraqabah. Alia is aware that Ahmad's instructions are unethical and experiences guilt and inner conflict. Her active conscience makes her recognize that what she is doing is wrong. Lastly is natijah. Alia temporarily protects her job by following Ahmad's instructions, but this comes at the cost of her professional integrity and peace of mind. She may also face disciplinary consequences for preparing and approving fraudulent financial statements.
So I will continue with influence of management pressure, incentive or performance target. Okay, so for the first one is capital market expectation. So NTK wanted to report financial performance and high EPS to attract investors for its new project. This pressure leads to recognize revenue prematurely and minimize disclosure to make the company's performance appear stronger. For the second one is managerial compensation. Ahmad's compensation was linked to the company's reported financial performance. To increase earning and potentially receive higher bonus, he instructed Alia to recognize full revenue immediately and revise asset useful life without proper justification. So for the third one is profit threshold. NTK aimed to achieve higher profit and maintain a favorable EPS. To meet this performance target, Ahmad manipulated accounting estimates and omitted material information, resulting in overstated profit. The last one is debt covenant. NTK had a loan agreement requiring its debt to equity ratio to remain below 15%. To avoid breaching the covenant and triggering immediate loan repayment, Ahmad manipulated the financial statement by overstating revenue and concealing Alphatech bankruptcy. So I will continue with ethical conflict between compliance and instruction. Alia faced an ethical conflict because Ahmad instructed her to prepare the financial statement in a way that did not comply with MFRS. As accountant, she had a responsibility to follow accounting standards and uphold the principle of integrity and objectivity. However, as a newly hired employee or on probation, she feared that refusing the director instruction could affect her job security. This created a conflict between complying with professional and ethical standards and obeying management instruction. Now I will evaluate NTK company's action based on ADAP framework focusing on ethical conduct, integrity, and accountability. First one is ethical conduct. And NTK management failed to act ethical because they manipulated financial information and prioritized company performance instead of providing truthful financial reports. According to ADAP, ethical decisions should be guided by conscience, honesty, and justice. Their action affected investor, creditor, employees, and other stakeholders. And for the second one is integrity. Integrity means being honest and truthful even when no one is watching. NTK management did not demonstrate integrity because they failed to present a true and fair view of the company financial position. Under the ADAP framework, integrity comes from self-awareness and ethical self-governance, not merely complying with rules. And for the last one is accountability. Management has responsibility to prepare accurate financial statement and protect stakeholder interests. However, they fail to take responsibility for their reporting decision. ADAP teach that individuals should accept responsibility for their action, reflect on their mistake, and make ethical improvements. So now I will explain well reason and recommendation. The alternative ethically sound decision. The recommendation is to revise useful life based on proper technical assessment. Before changing the useful life of the manufacturing assets, Ahmad should have obtained an independent technical or engineering assessment. The revised useful life should be supported by evidence such as maintenance report, asset inspection, or expert evaluation. This ensure depreciation expense is calculated fairly and prevent management from manipulating profit by reducing depreciation without valid justification. For this one is under governance or internal control improvement. So the recommendation is improve internal control. NTK should require proper documentation and independent approval before any major accounting estimate or policy is changed. For example, changes in useful life must be supported by technical report. For the second one is revenue recognition decision must be reviewed by senior finance personnel. Material disclosure should be verified before publication, and this control reduces the risk of management overriding accounting policy. So the last one is under measure to strengthen professional integrity and compliance. So for the first one is build an ethical corporate culture. NTK should promote a culture where honest, integrity, and accountability are valued more than achieving short-term financial targets. Management should encourage employees to report accurate financial information even if the results are less favorable.
Okay, now I will present the reflect on recommendation. Okay, for the first one is prevent recurrence. By applying the correct MFRS requirements, opportunities for earnings manipulation are significantly reduced. Combined with stronger audit committee oversight and whistleblowing channels, unethical practices can be detected yearly before they develop into major financial reporting failure. Okay, for the second one is ensure compliance, where regular ethics and MFRS training together with compliance with a MIA code of ethics and periodic internal and external audits enable accountants to apply accounting standards consistently and make objective professional judgments. This ensures that financial statements continue to comply with the relevant MFRS requirements. The third one is promote ethical reporting. Promoting honesty, transparency, accountability, and professional skepticism encourage accountants to exercise independent professional judgment instead of simply complying with management pressure. As a result, financial reports are prepared objectively and faithfully represent the company's actual financial performance and position. The last one is build a sustainable reporting culture, embedding strong corporate governance, continuous ethic trainings, and effective audit oversight into daily business operation, create a culture of accountability and responsible reporting. This strengthens stakeholder confidence, enhance corporate reputation, and support long-term sustainable business performance.